And Shruti Mishra. Here are the top headlines from the startup space. NCLT defers BYJU'S versus investors' rights issue case to June 6th. This means the EdTech cannot use rights issue money just yet. Salaries could be further impacted unless the company raises debt again. NCLT was hearing a plea filed by 4 investors regarding oppression and mismanagement at BYJU'S.
Space tech startup Dhruva Space has raised 78 crore rupees in its Series A2 funding round led by IAN Alpha Fund with participation from existing investors. With this, the company has bought its Series A copies to 123 crore rupees.
D2C natural beauty and personal care brand Nat Habit has crossed 100 crore mark in terms of its annualized revenues in FY24. The brand also aims to become EBITDA profitable over the next 17 to 18 months.
InterGlobe aviation promoter Rahul Bhatia and former Tech Mahindra CEO CP Gurnani have launched a technology company called AionOS, which will use AI to assist firms in decision-making through a SaaS platform in the travel, transportation, logistics and hospitality sector.
Australian Prime Minister Anthony Albanese calls Elon Musk an arrogant billionaire who considered himself above the law. This after X refused to comply with Aussie regulators' orders, asking them to take down videos of a stabbing incident in Sydney and not just geo-block the post. Musk tweets on X asking if e-safety commissar in Australia has authority over all countries on Earth.
Those were the headlines that we're tracking for you from the startup world. The top story this evening, there's no relief for beleaguered edtech major BYJU'S just yet. This after the National Company Law Tribunal deferred the rights issue case hearing to the 6th of June. Remember, the NCLT's order had prevented BYJU'S from using its funds from the rights issue and had asked the startup to deposit the money in an escrow account. Ritu, tell us more about what happened in court today. You've been following this through and through.
Well, yes, the summary is that there is no relief for BYJU'S just yet because NCLT's interim orders issued on the 27th of February continue to remain in force, and that means BYJU'S has to keep the funds raised from the rights issue in an escrow account and it cannot use them until the court's final orders in the matter. Now, during the hearing in court today, 4 of BYJU'S investors who have filed an oppression and mismanagement plea against the company accused BYJU'S of using the funds raised recently during the rights issue in violation of the NCLT order. They also alleged that BYJU'S had not deposited the money that it received from the rights issue prior to 27th of February in the escrow accounts, which is contrary to the directions of the court. BYJU'S refuted these allegations. It said it was fully compliant with the court's directions. The court has now asked investors to file either an application or an affidavit to put their claims on record within a week's time. The case, however, has been adjourned until the 6th of June. But keep in mind, BYJU'S has stated it needs this rights issue money to tackle the ongoing liquidity crunch, and that includes the payment of salaries to employees, vendor payments and so on. BYJU'S has already delayed the payout of March salaries and only partially paid the employees for the month of March. And with no relief in sight from the court on the use of funds from the rights issue, it remains unclear how the company is going to meet its obligations, including the payout of salaries to the employees in the coming months.
All right. Thank you for those details, Ritu, on investors versus BYJU'S, where NCLT has deferred hearing to June 6th. Moving on. Accacia, a decarbonization platform that focuses on the real estate and infrastructure sectors, has closed $6.5 million in its pre-Series A round led by Illuminate Financial, a specialist VC firm focused on enterprise fintech companies. Southeast Asia-based AC Ventures also participated in this round alongside early backers Accel and B Capital. To tell us how Accacia is helping the real estate sector step up decarbonization, joining me now is its founder and CEO, Anu Talreja. Also with me is Arundhati. Anu, welcome to Startup Street. Real estate and construction activity contribute to about, 40% of global greenhouse gas emissions. So first, tell us, how does your AI-enabled SaaS platform help real estate asset managers, owners and developers track their emissions? And then, of course, how do you design their decarbonization journey?
Hi, good to be here. So our platform is basically specially designed for real estate companies. Real estate has emissions across their value chain, and hence it's a very complex emissions tracking problem. Our platform automates data collection from different parts of real estate value chain. And with this automation of data collection, we have an algorithm specifically designed for all different sorts of asset classes within real estate, and can hence automate calculation of carbon emissions across the value chain.
Right. Hi, Anu. Arundhati here. What is Accacia's reach? What kind of projects have you managed so far? Give us a sense of your current business growth numbers.
Hi, Arundhati. So basically, we are a global player. We started our business in Asia, but we are now also working in North America. We have currently deployed a solution to over 25 million square feet of commercial real estate. That includes some of the top largest real estate asset managers globally, and includes all asset classes within real estate, including your typical commercial office, hospitality, data centers, logistics, all sorts of asset classes.
Okay. Anu, real estate is a hard to decarbonize sector given the complexity of value chain emissions, from construction, operations, and the variety of asset uses. So give us a use case as to how you design custom decarbonized strategies and solutions for your clients.
So, for example, one of the major areas where emissions happen in real estate sector is construction activity, right? So at the time of construction, we recently worked with a client who is one of the largest business conglomerates in India. So with them, they were constructing a new building. So while constructing the new building, it also involved demolition of a previous structure. So this was a very unique situation where you can actually save a lot of emissions by recycling of materials and reusing materials. So we first kind of helped them devise a recycling and reuse plan of materials, followed by what kind of materials and procurement process should go into the any new materials that they have to adopt for this new building. Along with that, we also help them optimize the entire procurement process to minimize the emissions that would be generated during the construction process itself.
All right. And, coming to the investment, Accacia is backed by marquee investors, including Accel and B Capital. What does their backing mean to you, and how do you intend to turn profitable? What's the revenue model at this current point?
So we are already EBITDA positive. We are a typical SaaS company. We sell software and we make revenues out of software. It's a monthly subscription revenue, and like with any enterprise software business, our margins are very, very high. But backing from leading players like Accel, B Capital, and now Illuminate and AC Ventures, I think gives us a lot of encouragement in terms of encouragement as well as the reach that we can have, right? So Illuminate, 4 of the 7 largest banks in the world are their LPs and are also their strategic partners, right? So this gives us unparalleled access to potential clients and potential trailblazers in the industry who could also be our clients.
Okay, speaking of encouragement, this funding comes at a crucial juncture as the Securities and Exchange Commission and Singapore Exchange have announced regulations on carbon emissions reporting, underscoring the urgent need for comprehensive and real-time climate risk data. Anu, how do you plan to tap into this huge potential? What are the growth and expansion targets that you've set for yourself?
Yeah, so Singapore is already a large market for us. About 60%, 70% of our revenue currently comes from Singapore. So we are already extensively working there. Apart from Singapore, we are also working in a couple of other Southeast Asian countries. So we plan to use this capital to expand our presence in Southeast Asia. Along with that, just last quarter of last year, we started with our first client in North America, in US. Now with the regulation coming in, those regulatory tailwinds are actually really, really supportive. And a lot of the capital that we have raised would essentially be focused on expanding in the North America market with the SEC regulation coming in.
All right. And if you could quickly tell us, Anu, before we let you go, you're an architect and urban planner by training. What has been the biggest challenge for you till date And reports suggest that a staggering $18 trillion of investment is required over the next decade to get the real estate industry to net zero. So what more needs to be done?
A lot needs to be done. $18 trillion is an estimate, but to get to that estimate, we first need to know where to spend. Unfortunately, this industry is at such a nascent stage that technologies where we could invest to decarbonize the sector, those technologies are in very, very early days right now. Most of them are not available for commercial use yet. So I think over next a few years, a lot of investment needs to go into innovative technologies that can help decarbonize real estate. And these goes from energy optimization, renewable energy,
Sure.
innovative green materials. All of these technologies, they all need a lot of investment. And especially when we talk of Asia-specific solutions for Asia-specific problems.
Absolutely.
A lot of investment needs to go in.
All right. On that note, Anu, we'll have to wrap up our conversation. But many thanks for joining us on Startup Street and wish you the very best for all your growth plans.
Thank you for having me.
All right, from real estate, we're going to move to the skies, where Bengaluru-based aerospace component manufacturer JJG Aero has secured $12 million, or about 100 crore rupees, in its maiden funding round from CX partners. The funds are going to be used primarily to increase its facilities' manufacturing capacity, further vertical integration, and other corporate initiatives. Joining me now to discuss this funding and the company's plans ahead is Anuj Jhunjhunwala, the CEO of JJG Aero. Anuj, welcome to Startup Street. Thank you for your time here. Start by telling us about this $12 million funding you raised and how you plan to deploy it exactly when you're talking about expansion plans.
Yes, good evening. And firstly, thank you for having me on the show. So we've recently opened our second aerospace facility. And as you said, most of the funds will be used to expand capacity here. We'll be adding a lot of more high precision CNC equipment, 2-axis to 5-axis. And really, we see being fully integrated as one of the key value propositions for our customers. So we'll be doing a little more backward integration and also some forward integration.
All right. You have 3 fully integrated manufacturing facilities in Karnataka, from what we understand. Do you have plans to expand the existing capacity here, or are you looking to set up more facilities elsewhere?
No, so we already had 3 sites. Now we've opened up our 4th site. This 4th site is a very large facility.
Okay.
And we're going to build it over 2 phases. So once all the phases are complete, I think it will take care of our huge growth plans over the next 4 to 5 years. And they're all in the Bomsandra area of Bangalore.
Where will this new 4th facility be?
They are all in the same neighborhood of Bangalore in Bomsandra Jigme.
All right. Primarily, JJG Aero is focused on building business in the commercial aerospace segment. But just to give us a sense, are there any new product lines, etc., you're looking to foray into? And give us a sense of how big the market opportunity here is that you're looking to capitalize on.
Yes. So our first plan is to move towards a higher value-added components, more complexity parts, more exotic alloys. We're also getting in new projects today which have some assembly and testing requirements. And lastly, we're going to make a big foray into the adjacent industries like aircraft engines. The size of the detailed machine parts industry is huge. We're talking of the range of $20 to $25 billion, depending on which segments you include. So really, we're still scratching the surface, even though we've grown so fast in the last few years.
Well, Anuj, speaking of growing very fast, I read in your statement that the company you claim is growing at a compounded annual growth rate of 35% in the last 3 years. What does that mean in terms of solid numbers you could share with us when it comes to your top line and bottom line? And at what pace do you expect this growth to sort of carry forward in the coming few years?
Yeah, so we just closed FY24 with sales of almost 140 crores. EBITDA margins are over 21%. We expect that to continue. CAGR will be in this vicinity, if not more. Within our company, the aerospace segment is growing very, very fast. We're talking of mid-50% over the next 3 to 4 years. So we're talking of a very, very huge opportunity.
Yes. Anuj, finally, just give us a sense of who your clients are and, primarily what geographies are you catering to? Are you looking at new markets? Are you in talks with newer clients, perhaps the government as well?
Yes, so we don't work with the government. We don't do defense as yet. We work primarily with the biggest names in the world of aerospace. You have the Boeings and Collins and Safrans of the world. The who's who of the European and American ecosystem in aerospace are our clients. We've recently added a lot of these clients over the last 4 to 5 years. The whole geopolitical rebalancing has really played in our favor. And even within these clients, each of them represent on average a $200 million machining sourcing opportunity. So really, we just want to dig deep, increase our wallet share within these clients. Within these clients, there are many business units. You're talking of huge companies which have like $50 to $60 billion of top line. So there are so many business units within these clients where we've still not entered. So our first focus is just to deeply penetrate our existing client base. Beyond that, we will be making a foray into aircraft engines. We're very close to that. And there may be a few more tier ones who will add on.
All right. Interesting updates there, Anuj. We wish you the best with them. And thank you very much for your time here and sharing your thoughts with us today.
Thank you so much.
All right, on that note, it's time for us to head into a short break. But coming up, from a failed restaurant business to a 1,000 crore rupee business, Veeba is now India's biggest homegrown sauce and condiments brand. Can the firm become a consumer goods company? We find out on the other side.
The reason of starting Veeba was that I was desperate and out of business. I had just shut a restaurant company. The best thing that field restaurant business gave me is that it made me see that there's a gap for sauces in the market. When we started
Welcome back. You're still with us on Startup Street. From a failed restaurant business to now a 1,000 crore rupee business, Viraj Bahl had to fight many odds to make Veeba India's biggest homegrown sauce and condiments brand. With 300 plus SKUs and a distribution network spanning 700 cities, can he now make Veeba a consumer goods company? My colleague Aishwarya Anand finds out.
The reason of starting Veeba was that I was desperate and out of business. I had just shut a restaurant company. The best thing that field restaurant business gave me is that it made me see that there's a gap for sauces in the market. You know, when we started Veeba, before that it was just mayonnaise and tomato ketchup. And for running that restaurant, I needed some specialty sauces and they were not available. 4 years of utter misery of a failing company gave me was an idea that sauces can be developed into a bigger category than what it is in India right now.
What does your product portfolio look like? And how many categories are you operating in currently?
We've got about 85 SKUs in retail. I think mayonnaise is our #1 SKU, and I'm happy to report that tomato ketchup is, by volume, not by value, by volume, already become our #2 product.
You have 2 manufacturing hubs.
Yes.
So give us a sense of what is the capacity of each of them and how many products are you churning out on a daily basis?
2 manufacturing units, as you said. One is in Neemrana. We started out with that unit.
Okay.
It is running at about 85% capacity right now, which is slightly around a couple of thousand tons a month. Then we have a larger unit, which is a 10-acre plant. That is currently running at about 55 to 60% capacity. So 24 SKUs will step out of the plant every day or step into the warehouse every day.
So would you call yourself a premium player or would you call yourself an affordable player?
Mass premium. Our products start from as low as 10 rupees, which is a one-time use pouch of mayonnaise and ketchup. We're trying to increase the market size. Leaving the 10 rupee introductory pouch aside, our product prices start from 34 rupees all the way up to almost 200 rupees.
Okay. Ever evolving consumer taste. What are some of the trends you're noticing there and how are you catering to those trends?
So we're seeing 2 trends coming out massively. One is wellness. Especially in the metros, wellness has started playing a role. So consumers have started asking us what's the sugar content, what's the fat content and what kind of oil do you use. For example, our organization has a very clear mandate that we do not use palm fat. The second and a very interesting trend we're seeing is heat, chili sauces. It's become a category on its own.
Do you plan to get into biscuits, juices? Are there plans there?
The VRB, the holding company which owns Veeba, VRB of 2028, 4 years from today, should be 4 brands in 7 categories. We've already launched our second brand. It's in the wellness space. It's called Earthmade. We're toying with the idea of an indulgence brand in the mocktail space.
You started out as a B2B company. So help us understand some of the big partnerships that you have in this space. What is your B2B market share like?
First client was Domino's Pizza. And after Domino's, we got business from Yum restaurants, Burger King, and so on and so forth. Today, the B2B part of our company is roughly 6% in revenue. 94% comes from our distribution and retail business. We actively decided to focus on distribution and we stopped B2B.
So how many retail stores are you present in currently?
I don't know the exact number, but around 200,000 plus or minus directly, and then indirectly much more.
The next frontier of growth is, of course, quick commerce. What is the kind of sales that you're clocking from that channel?
Almost 70% of our revenue comes from GT. General trade, the smaller shops. Almost 25% comes from modern trade.
Okay.
The Reliances and the D-Mart and all of that. E-com as a whole for the company is only 5% of our revenue. Blinkit, Swiggy and Zepto, they're the biggest in our e-commerce division.
Are you close to being profitable?
We are profitable.
You are profitable.
So the last time we raised money was in 2018.
Yeah.
We haven't raised money since then and we are profitable. We are approximately a 1,000 crore odd company.
Do you plan on going for an IPO?
So if we say I want to go for an IPO today, it will take us minimum 2 years from today to go for an IPO. So that 2-year time clock hasn't started as of right now.
How big is the sauce and the condiment market in India? And we're seeing a couple of new players coming into this space. So how are you navigating the vis-a-vis competition space?
Think of ketchup as roughly a 2,500 crore market. And all other sauces put together are another 2,500 crore market. So approximately it's a 5,000 crore market. I think some of the incumbents made the mistake of not taking us seriously when we were much smaller. So I respect the incumbents a lot, but we also respect the newcomers a lot.
And what about your global expansion plans?
We've just started shipping to Middle East, and we started in a very small way, something in the east coast of US.
Moving on, also on what's brewing, InterGlobe aviation promoter Rahul Bhatia and former Tech Mahindra CEO CP Gurnani have launched a technology company called AionOS. The firm will use AI to assist other companies in decision-making through a SaaS platform in the travel, transportation, logistics and hospitality sector. CNBC-TV18's Shireen Bhan caught with both of them to find out more about the new venture. Take a look.
Few clients with whom we are doing proofs of concept. I left Tech Mahindra on 19th of December, and since then most of the days when we have been working together, listening to the customers, talking to the prospects, building teams. So I think over the next 1 year you will see a lot of good announcements. This is just the beginning.
About a year before he did, and we were just having this conversation about trying to team up together. We used to have a technology business at some point in time, which we had sold in 2018. And it was just one of those things, after having sold it, we wanted to go back into the space. But obviously we were looking for the right sort of partnership, and CP and I talked for most of last year and came to the conclusion this is something we'd like to do together. And here we are.
Okay, on that note, it's a wrap on this edition of Startup Street from Shruti, Arundhati and me. It's a goodbye, and thanks for watching. Stay with CNBC TV 18 for more news and updates on the other side.